Hello guys, my name is Colin and this is ColinTalksCrypto. This is a very important video. I'm going to cover why the bottom of both the stock market and Bitcoin are most likely not in. I'm going to show you a huge mistake that I think a lot of people are making in the crypto space right now when judging where the bottom is. I'm going to show you why I think there's at least 1 year or more until we reach the bottom, and why we could have another 50% drop coming by the actual bottom. In part 2 of this video, I'm going to show you just a couple of very simple metrics. They're the metrics that I'm actually going to be using to make sure that I don't buy in too soon. I don't FOMO in too quickly to the market as it's dropping, and also to make sure that I don't miss the relative bottom. And these are very simple indicators that anyone can follow me with, and I think they're extremely powerful. And in part 3 of this video, I'm going to be showing you why I'm not going to be following the CBBI when buying. That's the ColinTalksCrypto Bitcoin Bull Run Index. And I'll make a statement on that and explain to you, and I think you'll get the picture by the end of the video, why I'm going to say that. It plays into the huge mistake that I think that many crypto investors are making when judging the economy. And I myself fell into that trap, and I think I've finally come out of that confusion, and I'm going to share that with you guys, and you can make your own judgment call of what you believe. So I'm going to do my best to make this video concise, so let's just get through these points A to B. First of all, let's take a quick look at the S&P 500. You can see here, this is weekly candles going back to 1989. Right here is the 2000 crash. Right here is the 2008 housing crash. Right here is the COVID crash. And we are here today. I've drawn in red lines here, here, and here, the various support lines that I think are likely to be hit by the bottom of the actual bottom of the cycle. The first support line is a 50% drop, around 2,350 on the S&P 500. The top of the market was around 4,800. And this is an interesting support line because it's exactly a 50% drop, and it also lines up with this drop in the S&P 500 in December of 2018. So there is support there. I think that the next most likely support line is a 56% drop from the all-time high, which lines up with a lot of support right here. A lot of trading activity took place in this particular 56% drop from where the high was on the S&P 500 back in 2015 to about 2016 or 17. There was a couple year period where this formed a very strong resistance, which when passed is now flipped and become a likely support zone. In fact, I think that's probably the most likely point for support. The next most obvious support line is the tops of both the 2000 and 2008 cycles, which basically formed a double top about 7 years apart. And that is an extremely strong support line. And that would be a 68% drop. I didn't draw it here, but that would be a 68% drop from the all-time high of 4,800 on the S&P 500. Later in this video, I will circle back and I'll kind of sketch out what I think is going to happen on the right side of this chart so you can get a feel for how far I think we have to go and the timeline that I think it could take to accomplish that. So that brings us to the next question. Why am I showing you the S&P 500? That's because Bitcoin and all cryptocurrencies for that matter are heavily correlated to the stock market. And this is actually the big mistake that I think that everyone is making right now, or at least a lot of people are underestimating right now. The correlation. If I could sum up one word for this video, it would be correlation. Bitcoin and cryptocurrencies are correlated. Sure, they might have minor deviances here and there on a small to medium time frame. On a larger time frame, they are undeniably correlated. Bitcoin came into existence around 2009 as a response to the housing crisis right here. Bitcoin thus has only experienced a secular bull run. This is very important for this video. This is the key point here. A secular bull market is a long-term bull market. secular bull markets tend to last anywhere from approximately 15 to 20 years, or they could go even longer. So when we're referring to a secular bull market, we're referring to the stock market from 2009 to 2021. Bitcoin has never experienced a recession. The only recession it's experienced was a brief dip from 2020 in March during the COVID crisis. Bitcoin also collapsed during that time. So if that was any test, it failed miserably as a store of value during a time of stress. So really, throughout the entire 12 years thus far of Bitcoin's lifespan, it's only been accompanied by money being pumped endlessly into the stock market. And only until recently, the beginning of this year, with the peak of the S&P 500 at 4,800, that's January 2022, have we seen a change in the direction of the market. Now, some of you might be thinking, the market's basically bottomed and we're going to shoot up from here. But here's why that's probably not correct. Let's take a look at the longest bear markets since World War II. The average percentage decline of the past 5 largest bear markets since World War II is 43%. Also, taking an average could underestimate the potential drop because if you'll notice, as time has gone on, the drops in these bear markets have gotten larger and larger over time. This is likely due to the ever-increasing amount of printed money being pumped into existence over time. So a greater than 50% drop in the S&P 500 would not be unusual given this progression. Well, how much have we dropped so far? We've dropped only 27%. And we've retraced quite a bit up of that. So would that make sense to be the bottom of this market? I think it's clear for anyone who understands what happened to the United States and other countries' monetary supplies during the COVID pandemic, understands that it is very unlikely for this to be the end of the drop, given how much the money supply was inflated during this couple-year period. We essentially doubled the monetary supply of USA in a very, very short period of time. And so it would not make sense for a 27% drop to be the end all of the correction. And it's backed up by the fact that the average is much more than 27%. Even if we just reached the average drop in a bear market recession drop, it would be 43%. And that's the average. It could go higher than that. It could be a 56% drop like we saw in 2008. It could be a 50% drop like we saw in 2000. So the first point to make here is it is extremely unlikely, given the magnitude of money printing, that we are at the bottom of the market after only 1 year of downward motion and only 27% drop. So believe it or not, the comparable drop in reality to what we saw back in 2000 or 2008 with a 50 or a 57% drop would be these two support lines that I just showed you. And this would be an S&P 500 score of 2350 or 2100. Keep in mind, we are currently at a score of 4026. So that would show that we are actually nowhere near the proposed bottom. Now that brings us to the next part of the video, which is just the few simple metrics that I'm going to be using that I think are extremely powerful and should not be overlooked in determining where the bottom will be. And I should note here that the reason that this is so important is because Bitcoin is so correlated to the stock market. That's the entire premise. And this is what I think a lot of the crypto space is not seeing. I think that a lot of the crypto space is looking at the Bitcoin metrics. And the Bitcoin metrics are showing that we are at a bottom. The Bitcoin metrics only have been around during a secular bull run. So it makes sense that the Bitcoin metrics would not show the performance of Bitcoin during a proper full-blown recession. Bitcoin was not around in 2000. It was not around in 2007 or 2008. So it's interesting because the crypto space tends to focus myopically, myself included up until very recently, on just the Bitcoin metrics. And if you follow just the Bitcoin metrics, yeah, it looks like we're at the bottom. It really does. Even my CBBI, which is based on Bitcoin only metrics, says we're at a score of like 3 or 4 with a bottom of 2 recently. It says we're at the bottom. And I don't think we're at the bottom because Bitcoin is heavily correlated to the stock market, and the stock market has a long, long ways to go before we bottom out. And it's only if you admit this to yourself, the correlation and the distance we likely have to follow, even just to reach the average longest bear markets in history, that you can actually begin to see that there's something wrong with the fact that all these Bitcoin metrics are reporting we are at the bottom when the stock market is saying completely the opposite thing. So what we need to do is stop looking at Bitcoin metrics only. We cannot only rely on those. Those are great for a secular bull run, but they're not going to help us during a recession. And that's the wake-up call. And that's the mistake that I think the majority of the crypto space is making, ignoring the recession, the future recession as well. I think we're already in a recession. I think it's going to get much worse. So here's the couple of charts and graphs that I'm going to be looking at, really just 2 plus 1 more as a safety check. Really just 3 total charts. Here they are. First of all, the MMTH. I've talked about this before, and I think this is extremely important, perhaps more than I've ever realized before. The MMTH is simply the percent of stocks above the 200-day moving average. Currently, it's at 46. 46% of all stocks are above their 200-day moving average. That is tremendously high. We hit a recent low of around 15%, as you see right here. Now, historically, back in 2008, when the housing crisis occurred, we actually reached a low of approximately 3 right here. And with COVID, we even dropped down to 5 briefly. These are monthly candles, by the way. So we only recently saw it kind of double bottom off of the score of 15. I really don't think that's the bottom. In fact, I'm putting my money where my mouth is because I'm going to be sitting on my cash waiting for the MMTH to go into the single digit territory. That means below 10 on this chart, and ideally 5, which is very rarely reached. You know, every 3 years at the most, more like every 10 to 20 years, is a score below 10 reached on the MMTH. And because Bitcoin is highly correlated to the stock market, you know, it's a very volatile asset class. If you think the stock market is volatile, Bitcoin is like the stock market on steroids. So if you think that, like I do, that the stock market has another 50% drop roughly till the bottom, then what do I think that Bitcoin's going to do? Well, if I have my head in the sand and I'm only looking at Bitcoin related metrics, then I think that Bitcoin's at the bottom. But if I actually honestly admit that Bitcoin is, at least currently, I'm not saying for the rest of our lives, currently correlated heavily to the stock market as an extremely volatile beta asset class to the many trillions of dollars slushing around out there in the legacy stock market, then that is when you can be honest with yourself and say that this is the type of chart you should be looking at, because the Bitcoin charts are saying we're already at the bottom. And I think that what will happen is a lot of people will buy in before we actually reach the bottom. They'll buy into Bitcoin before we reach the actual bottom, because that's what all the legacy Bitcoin charts are saying. But if Bitcoin's only been around during this 12-year secular bull run, it hasn't had a chance to even factor in how its performance is during a recession. I think you get the point there. So that's why the MMTH is so vital. When the MMTH rounds this top, we see another leg down. I think that's going to happen fairly soon here, at least the beginnings of it. I think it could take several months to play out. Eventually, we're going to reach a score below 10. I feel very strongly about that based on the magnitude of the recession that I feel we're in. So why the heck would I put my money into Bitcoin when the MMTH is at 46%? That's extremely high. I'm not going to do that. I'm not going to do that anymore, guys. CBBI says we're at 2 or 3. I think it's foolish to dump our money into the market when Bitcoin specific metrics are saying we're at the bottom. So this is chart number 1. This is the first data point that I'm going to be looking at. Very simple to look at. You can look it up in TradingView when looking at whether we're at the bottom. Are we below 10 or not? Period. The next chart I'm going to be looking at is the correlation, and take a look at my last couple of videos where I break this down in depth if you want to learn more about this. But this is the second chart that I'm going to be looking at. I'm going to be following specifically the effective federal funds rate. That's basically the interest rate that the big banks set for themselves. And then the interest rates that the consumers experience are based off of that. So when mortgages go up, it's because the federal funds rate has gone up and therefore mortgages go up. And by raising the federal funds rate, that's how you slow down the economy, because it's not easy to borrow money because the interest rates on taking a loan out are suddenly much higher. Likewise, the interest rates for a mortgage are much higher. So less home purchases, less employment, less business growth, less lending, everything slows down. And that's what the Fed is trying to do right now by raising the federal funds rate. But there's a very unshakable correlation between the pivot point when the federal funds rate actually begins to drop and when the stock market bottoms. It's uncanny. It's almost one for one this happens. It's so often that it happens, it's the exception to say otherwise. So you can see here the vertical blue lines are representing the Fed pivot. And I'm defining the pivot as when this blue line actually starts to decline, when the Fed has decided to begin reducing rates. Not to say that they've reached zero, just the direction has head towards zero, and that's where it's going from that point forward. That's a Fed pivot. And coinciding with a Fed pivot, 1 to 2 years later, almost always, is this orange line, which is the S&P 500 bottom. I used to think that the Fed pivoting was a very bullish thing until I charted it, and the proof is right in front of my face. Every one of these examples on this chart right here shows that the Fed pivot comes before the bottom. And so if you want to know when the bottom is going to be, just look for when the Fed pivots. It's almost like a cheat sheet. So back in 2000, we saw the Fed pivot, and then about 2 years later, we saw the S&P 500 bottom. In the housing crisis, we saw the Fed pivot around 2007, and then we saw the S&P 500 bottom in 2009. Currently, we haven't even seen the Fed pivot. So this is another clue why I know we're not at the bottom. If the Fed had pivoted, then within a year or two, then we'd be at the S&P 500 bottom. We haven't even seen the Fed slow down its hikes yet. We've been seeing dramatic 75 basis points or 0.75% increase month after month after month. This line is very steep right here. So if we haven't even slowed down yet, that means we have a while to go before that occurs. We'll be lucky if that happens soon. Maybe they'll do 0.5%, 50 basis points soon. That might happen for a couple months. Eventually, it will begin to go flat. And that's where this blue line kind of flattens off here. Just like we've seen in the past, it tends to have a little flat period where they try to just let things settle out. And then only after that do they begin to decrease. They always try to do this very gradually. The problem is they always overshoot and they always over tighten and they always raise these interest rates too high and they damage the economy. And I think they're doing it on purpose. They're damaging the economy because they've screwed up with inflation, back with the COVID money printing where they doubled the monetary supply, and now we're paying the price. And so now they have to put a stranglehold on the economy to get things under control. Otherwise, they risk having rampant run-on inflation, and that would be a death sentence. So what they do is they make all of us pay, and they over-tighten, and they basically make many of us lose our jobs. They make us have a difficult time getting homes, being able to pay for just anything, really. But the point being is that we haven't seen this pivot yet. And based on the pattern of how long approximately it seems to take for a pivot to occur, my guess is we're going to see a pivot from a flatlining of the Fed interest rates to a decrease in the year 2024. I mean, this just puts some timeline and perspective there. Some of us, I think many of us, in fact, myself included, thought we were going to start seeing some bottoming action in the coming few months. And I think that we will not even see the Fed pivot until perhaps 2024 to a decreasing interest rate. That means that it's going to take a year or two for us to find the bottom. And so that's what this chart is showing. I'll let you analyze it if you want. Please do watch those last two videos I made where they go into this in depth. I think it'll give you a better grasp and feel for what I'm talking about here and why I'm so emphatic about this chart being very important. So I'm going to wait for the MMTH to go below 10 to go into single digits. And I'm also going to look for a Fed pivot into the decreasing nature of the effective federal funds rate. If I see the Fed pivot, then I get ready in about a year, give or take, year and a half, something like that, to look for the actual S&P 500 bottom. Until that pivot occurs, I don't think that we've hit the bottom. And that does match with what I've shown you here. I think that we've only, as a 27% drop, have a long ways to go before the actual bottom. So it actually is all lining up. It does make sense. The Fed continues to increase interest rates, and we are not anywhere near the bottom. Eventually, they're going to flatline the interest rates. Okay, maybe we'll be a little closer at that point. There'll probably be a little bullish rally because people get excited because, oh, they stopped increasing the interest rates. Well, when they begin to decrease it, that's when things start getting bad. And as you can see, as I've drawn here, this orange line, that's where it begins to drop the most. After the pivot, after the Fed begins to decrease the federal funds rate. So those are literally the two charts I'm going to be looking at. And I'm looking at those, and I'm not looking at the Bitcoin charts because Bitcoin is heavily correlated to the stock market. And if you look at the Bitcoin charts, everything's going to keep saying we're at the bottom. Probably the Bitcoin charts are going to say we're at the bottom for the next 2 years. That's what I think we're going to see. And it's going to cause people to continue to buy and buy and buy. And the Bitcoin price is going to keep going lower and lower and lower. They're not going to have bought the bottom. They thought they were because all the Bitcoin charts are saying we're at the bottom. But that's because they're not factoring in the legacy economy, the stock market, which is so heavily influencing the Bitcoin price. Now I'm going to show you a third chart, and this is my backup plan. This is a more conservative method for not missing a bull run and not missing a bottom. This is the golden cross ratio. A golden cross ratio suggests a long-term bull market going forward, while a death cross suggests a long-term bear market. And I've drawn it for you here. This is the Bitcoin price chart. So I am going to look at the Bitcoin price chart for this particular one thing, the golden cross. Basically, we have a 50-day moving average, which is this yellow line, and we have a 200-day moving average, which is the purple line. Anytime the yellow line moves up, flips up over that purple line, like right here, that is extremely bullish. It's a long-term bullish indicator. Anytime that 50-day moving average crosses down below the purple line, like right here, that's a bearish indicator. Basically, if you had followed the golden cross and the death cross consistently through Bitcoin's history, you would have made a lot of money. So I'll let you take a look at this on your own. I don't want to spend too much time on this chart, but I just want to show you a couple things. So right here, around May of 2020, was when the golden cross occurred. And you can see that it was correct in this case because we had a bull run go all the way until $64,000, and the price did drop down a bit right here, and we had a death cross. So like I said, it's a conservative backup indicator. It's not going to let you catch the absolute top. It's not designed to. These rolling moving averages won't let you do that, but they will keep you from making a huge mistake. And even in this case, let's say you sold right here when Bitcoin was $37,000. Well, if you had bought when the cross occurred, you would have bought at $8,000. So you would have made a 4x increase by following this indicator. Now you can see that it crossed again here, and it's okay as long as you follow it each time. So right here, you would have sold. You would have sold your Bitcoin because the death cross occurred. But then we had another golden cross right here at 45,000. And then we had another death cross here at 48,000. So in a way, these two kind of negate each other. And you can really say that you basically ended up selling around, I don't know, 45,000 or 40,000, somewhere around there. And then look, it doesn't cross again. So you would have been protected from this entire rest of this bear market portion. You would have sold your assets and not lost all this money. So take a look at that chart and follow it through time and see what it would have done and decide for yourself if you think that's a useful indicator. I think it makes a great backup indicator just to make sure you didn't miss out. So back to the S&P 500. What do I think the chart's going to look like? How do I think it's going to unfold? Here's what I think it's going to look like. I think that over the next year or two, we are going to wait for the Fed to pivot. The Fed is finally going to pivot right here, this first blue line. the market's going to rally a little bit. It's going to seem bullish. But as we know, when the Fed pivots, it's nearly always followed by the final capitulation, the steepest part of the drop of the S&P 500 bear market cycle. So this Fed pivot is not bullish. This means that we're getting closer to the bottom. And so then I think after that brief rally, the price then drops down to its actual bottom over the next 1 to 2 years. And that 1 to 2 years, again, is because that's how long it has historically taken from peak to valley right here of the S&P 500. That's roughly how long it takes for a major recession. So we're waiting about a year or two after the point where the Fed starts decreasing the interest rates. So a Fed pivot somewhere in late 2023, probably 2024, and then a actual S&P 500 bottom with a score of possibly 2100 to 2350 in the year 2025 or 2026. That's what I think we're actually looking at. And that to me is a very realistic outcome. That also means we probably won't be seeing a new all-time high in the stock market for at least 5 years, possibly 10 years or greater. I think this is of that magnitude. Obviously, right here at the bottom of the S&P 500, it will be timed most likely with the Fed turning on the money printers, afterburners, and pumping money into the economy. They're going to have no choice but to do it. That's what happens at the bottom of each one of these cycles, and that will be the reason for recovery. But it's not going to be after an enormous amount of pain. And so guys, I want you to be just thinking with this possibility. I'm not saying I know this is right. I'm just saying this looks more probable than following Bitcoin metrics that are not following anything except for a secular bull run. And they're all saying the bottom is in, and yet how is that possible when we've only seen a 27% drop on the S&P 500 and we likely have another 1,200 point drop on the S&P 500 in store for us? What do you think that's going to do to the Bitcoin price? If Bitcoin is $16,000 right now, when the S&P 500 is 4,000, well, what happens when we have an S&P 500 score of 2,400? I think we could see below $10,000. I really do. I think this cycle is not going to be like the other Bitcoin cycles, and I think that is because of the recession and because of the correlation. So guys, correlation. Do not forget that. Do not be fooled by Bitcoin only metrics. I think that that is the reason, the sole reason we could see, and is fairly likely to be the case, that we're going to see a Bitcoin price under $10,000 in the coming several years. Lastly, let's talk about CBBI. CBBI is something that I have created and poured my heart and soul into, and it's based on 9 Bitcoin specific metrics averaged into one score. The problem is that it doesn't look at the broader economy like I'm talking about now. This is a more recent revelation to me, and something that I feel is so important that I'm going to make this statement about something that I've created. CBBI has been in beta since inception, but CBBI does not account for macro recession factors like the S&P 500, like the stock market, like the Fed interest rates, because it's based on metrics that have never seen a recession. It was invented after the 2008 housing crisis. Bitcoin has been in a secular bull run of the stock market its entire life. Thus, while the metrics would probably correctly indicate a Bitcoin bear market bottom during a continued secular bull market of the stock market, we are no longer in a continued secular bull market of the stock market. As such, it doesn't make sense to follow these Bitcoin only metrics because they are blind to these external legacy economic factors. I do think there is a distinct possibility that both the stock market and Bitcoin will go much lower than anyone is expecting due to this correlation. In my view, the stock market is really already in a recession, and it's just going to become an even worse recession over the next 1 to 2 years. As such, I'm going to leave the CBBI up as a matter of interest and reference only, but I will not be personally using it for my buy signal, as I don't think it will be correct. I think it's going to indicate the bottom for a while, and I think we're going to keep dropping in the Bitcoin price. So if I think that, why would I follow it? And this is me just being honest with you guys. I'm never anything but I invented this. I spent a year tweaking it and perfecting it and working on it. And I'm telling you right now, I'm not going to be using the CBBI in any serious way during this particular bear market cycle because we are in a recession that has never been seen before. Therefore, how can that work? How can that make sense? I don't think it does. Perhaps there may be a use for CBBI in the future when we return to a regular secular bull run. I think that will be in the cards, but that could be 5 to 10 years away from now. I need to know when to buy. I need to know where the bottom is going to be. And you guys do too. So I want to make sure that no one's being misled or fooled. And at least I'm being honest about what I see here. Perhaps in the future, additional economic factors could be included among CBBI's metrics to account for the external influence of the stock market upon Bitcoin. And that could be another project in itself so that it does take into account the external factors to Bitcoin. And there's also a case, perhaps someday, a decade or more away, that Bitcoin will actually decouple from the stock market and no longer need to look at external factors. I think that's what we're all here for, and I think we will see that day, but I don't think that's tomorrow. I don't even think that's this cycle. So I think we should be smart and look at what we're actually presented with. And if we're honest with ourselves, we're honest about the correlation, and therefore we're honest about looking at these external correlated factors that drive Bitcoin and are probably going to drive Bitcoin much lower than all the Bitcoin metrics are showing right now. So guys, I hope you found that useful. I'll be keeping a close eye on the MMTH and the pivot point for the Fed fund rate. And for backup, I'll be looking at the golden cross and the death cross. Please share this video if you find it useful. I do want to save people from making a grievous error in thinking that our drop is over when really it looks like we have quite a ways to go. And it could take a lot longer than people are thinking as well. Have a great day. Take care.